Let me introduce him now, Tushar Pradhan, Chief Investment Officer with HSBC AMC. Tushar, morning, good to have you back. Tushar, how worried are you about the current global and local market construct? Globally, emerging market debt is experiencing a lot of stress. Because of that, Rupee is under pressure, and if Rupee remains under pressure, all the hopes of economic recovery automatically will get challenged.
Well, these are interesting times, as you say, Nikunj. And one of the things that comes to mind when you said that is that what we are ignoring really is that all of this is as a result of a very strong dollar, which is due to the fact that you've got some very positive economic news coming out of the US. That has led to a conventional increase in bond yields, and with a very low inflation in that country, real yields now in the US are actually much better compared to emerging market yields, which is why initially there was a move to emerging market debt in the first place. So I think as soon as this change has happened, there's been a lot of redemptions out of emerging market bond funds, and that has led to a lot of weakening across all emerging market currencies, and I think India is no exception to that. To that extent, I think this is a short-term phenomenon. I think one needs to more or less watch this space as we go along. But I think when it comes to the fundamentals and going forward, I think India continues to remain fairly attractive, since the fact that all the other emerging markets are not really that diversified across industries as India is, continues to have a very strong demographic angle to the story. So I think long term, I don't think there is any reason for foreigners or for that matter any investor to get worried about the India story. But these are factors that will happen from time to time, and the bond markets being what they are volatile. As much as what we got the benefit of because of the higher interest rates in the past year with the kind of inflows that we saw, I think when the rate reversal happens, we shall see some of this as well. So I wouldn't really be very overly concerned at this time.
Tushar, in the near term though, do you sense that there could be further downside to the markets? I mean, technically we've already breached the 200 DMA both for the Bank Nifty as well as the Nifty. Do you think there is another 5 to 10% downside left purely on adjustment of how much the currency has lost?
Yeah, clearly there is always this possibility that the market may go down further, because as we all know that the market is momentum driven. So when it takes a direction, it does go beyond the fundamentals. So while I feel quite comfortable with valuations at the moment, I think there is every chance that the market does overachieve both on the way down as well as on the way up. So I think there is enough possibility for a much weaker market in the interim from here.
Tushar, I guess you're painting a very optimistic picture because if Rupee falls more, then automatically the macro will get challenged. If the macro will get challenged, Reserve Bank of India will not cut rates. If Reserve Bank of India will not cut rates, private sector capex will not kick in. So it's I guess a virtuous cycle. Everything is dependent on flows and Rupee.
Yeah, I agree to your point to a certain, let's say, extent. But the point I am trying to make is that the fluctuation in the Rupee is a given. It is not something that can be wished away. While we would like to have a very stable currency environment, it is not always going to be possible. But does that mean that a volatile Rupee really underscores the fact that India is not an attractive destination? That is where I disagree. I think in the interim, these things will definitely have an impact, and if the currency remains where it is, which again I don't believe it may remain, then we definitely have a problem, because then we are talking about again the current account deficit going higher, our oil imports costing our country a lot more, and the entire picture becoming quite bleak from where it is right now. But we were just celebrating the fact that commodity prices are lower. The currency till some time ago was fairly stable, and we were talking about a pretty significant reduction of the current account deficit just about a week ago maybe. All of that has changed overnight, and I don't think that that is something which is again a change back to much worse times than before. So while commodity prices continue to remain on their downward motion, the currency volatility, if it starts to subside and we stabilize at a certain rate, I think the India story will come back.
So based on how globally and locally things have moved in last 10-15 days, are you likely to rejig your portfolio rather drastically, or you are unlikely to rejig your portfolio and you will still bet on your core holdings, which is private banking, niche consumer and some industrials?
Well, I think at the moment we don't see any significant reason to change our portfolio positioning because, as I said, the fluctuations really affect the interim more than the longer term. We will be waiting and watching to see whether this trend actually becomes more solidified and to see where the rupee finds its level. As was mentioned earlier, all the emerging markets have fallen in line with India versus the US dollar. If that is the case, then we are as attractive or not attractive as the other emerging markets from an investing dollar perspective. So we're not any worse off. From a more fundamental perspective, if we look at what has happened to us, I think more or less likely affects everyone else as well. A weaker commodity cycle actually is something which is actually not as good for economies such as China, for example. But for India, which is a very large importer of commodities, and it does depend a lot on how low these commodities can go, this definitely is a much better signal for us going forward. Just take a contrast to Brazil, which is a very commodity-oriented country, and in a face of continuously dropping commodity prices, the equity markets in Brazil would be a lot more challenged than, say, a market like India, which is a healthy mix of commodity producers also, as well as commodity users, which will definitely benefit with the drop in prices globally. So I think I'm not overly trying to paint a very positive picture, but I'm just trying to say that on balance, I think the attractions for India continue to remain.
So Tushar, in the near term, is it time to go light and take profits out from high beta and rate sensitive names like banks as well as real estate, or would you outright short them?
Well, it's difficult to comment outright on sectors such as those because we do follow a very longer term approach to portfolio construction. While we do make some adjustments along the way, I don't think, as I said, a very drastic move away from banks also is warranted, because you have to remember that most of the downside is more or less priced, especially in the public sector bank space, while in the private sector bank space you have to look at resilient earnings as a signal to continue to remain invested. So I think nothing again overall changes in my view in terms of whether we take a very drastic move away from financials at this time.
Have you added any IT to your portfolio though?
We have rejigged our IT portfolio and we continue to remain a little positive on IT, but this was much before the drop in the currency, and that's not been a trigger at all. In fact, what we were talking about earlier was the fact that the US is showing some very positive economic signs, and that is on margin something really positive for the IT space because most of the client base is in the US. And I think we were pretty positive about the fact that things will start to improve as we go along there. And we were positive on the IT sector, and we were a little overweight vis-a-vis the index. So we continue to remain fairly positive on the IT sector, but not necessarily just because of the drop in the currency vis-a-vis the dollar.
Tushar, given the way how developed market equities and especially how US equities have moved this year, what to your mind are the chances that emerging market equities may not do well for another year or two? Because all of us are of the view that emerging markets eventually will recover, and within the emerging market basket, India has a very strong case. But what happens in a scenario where emerging markets do poorly and developed market equities, they continue to do well like they've done in 2013?
Well, as I was saying, I think there is a little chance of that repeating this time because of where the commodity cycle is. And I think commodities being under pressure are not something which is exciting from a BRICS perspective, especially if you take Brazil and Russia among the BRIC countries as an example. They will face pressure. In the past, what has happened is the emerging markets have moved up for the fact that the global markets, the developed markets actually become very attractive from a currency perspective, and a weaker local currency for most emerging markets is actually something which is good because they're export oriented. Now in India's case, what happens is we are an import oriented country, and that actually works the reverse for us. Going forward, I think a weaker currency for India, if it continues to be a reality, obviously will put our economics under pressure. And I'm maintaining the fact that it will be a lot tougher for us to recover from a weaker rupee. However, 2 points I want to make here. I don't think that this is a permanent place for the rupee to find an exchange with the dollar. Second is, while the commodity cycle is in our favor, I think there will be domestic growth that we can obviously keep pointing to continue to ensure that our economy chugs along. So I think while not becoming black and white and saying that it will either be good or bad for India, I think I don't see a reason to get overly worried about India. At the same time, I'm not so excited to think that India is going to be the star for markets going forward. Your comparison with the developed markets, I think the developed markets are trading at all-time highs, and obviously observers even in the domestic developed countries have started to worry that this kind of returns may not be sustained, and they may be moving away from developed equities into looking at more attractive destinations as well. So we seem to be, as I said earlier, in interesting times.
So Tushar, at a time when you are of the view that we are or we could be staring at a new growth cycle very soon, what are you loading up? Are you loading autos because they will benefit because of a rate cut, or are you loading industrial machinery and capital goods stocks because they will benefit when the economy will when the economic uptick will start?
See, every economic cycle brings along with it a chronology. So, for example, we are not going to get gung-ho about longer-term, long gestation power projects, for example. I think that's still a very, very far point away. The valuations in all of these sectors are very, very attractive. We'll stay away from those. But the first signs of an economic uptick will be shown in light engineering, will come up in certain basic or let's say small capex across industry. And that is really where the attraction should be for now. So what we are looking at is which are the early cycle stars where we can focus on an uptick, and that is something that will definitely benefit in the next 6 months. As the economy picks up and we get signs of a much more sustained economic upcycle, we should move to medium term to up to large term project companies, and that's really the third phase of the cycle. But at the moment, as I said, we're not making any dramatic changes. We're not betting on growth coming back with a bang. We're not betting on the really, really down and out power sector, for example, the power construction sector. I think there is still a lot of pain there before it can start to move out of it. So I think we have to take a graded step, and I think what we're looking for is very select engineering plays in the industrial and manufacturing space. We're continuing to look at banks because they will definitely fund the recovery, and we will look at some ancillaries along the way in the auto sector as well.